We're very excited to host today's webinar, Taxes in Retirement. I'm Josh Goulding with 4J Wealth Management. I'm joined by Jamie, Jeff, and Jennifer. And we are thrilled because we actually have record attendance for this webinar. There's more than 60 people on this webinar. I didn't realize that taxes in retirement was such a popular topic, but we're thrilled to have you here. You're all taking time out of your busy days to watch this, to listen to what I have to say, and watch the slides. So it's obviously important to you, and we want to make this as exciting and interesting to you as possible. So we're going to follow the same drill we have for previous webinars for anyone who has not attended our webinar before, which is that there is a Q&A box at the bottom of your screen, and you can type in your questions, and we will then address those questions at the end of the webinar. So it's a pretty action-packed, obviously taxes, tax planning, this is some pretty exciting stuff, but it can get detailed, as you know. But before we get into the details, I have a question for everyone here. And that is, why are we here? And the answer is, we are here to get answers and learn the truth about taxes in retirement. And the truth about taxes in retirement is probably not something that you're expecting. So a lot of people, they think that they, are ready to hear this, but the truth about taxes in retirement, in order to really understand where we are today, we have to take a step back and look in time. So it's kind of an interesting situation, because for the last 46 years, our industry, the financial services industry, have been telling people that your taxes will go down in retirement. And for 46 years, this has been true for most Americans. Because of that, the government, the financial services industry, created an entire universe of tax-deferred retirement savings plans. IRAs, and you're going to be familiar with a lot of these: 401ks, 403bs, SEPs, simple IRAs, tax-deferred annuities, Kehoe plans, ESOPs. All of these plans, right, allow you to put money in pre-tax and grow it tax-deferred. And that's a brilliant concept, right? A totally brilliant concept. I get to pay no tax now. You're going to let the money grow tax-deferred over 30, 40 years, and then pay the tax when you take it out. The reality is that not only did it work, and man, did it grow, but it exploded. I mean, from the time ERISA was first passed in 1974 to 2020, retirement assets have grown from basically $0 to 28.9 trillion. That's trillion with a T. Okay, that's bigger than the entire gross domestic product of the United States. So that is a massive, massive, epic amount of money that is now in retirement plans. But today, things have changed. So where are we today? Let's take a look. The Tax Cuts and Jobs Act was passed in 2017, and individual tax rates were cut across the board. So across every single bracket, taxes are slightly lower. Okay, as you can see there, that's what they are. And that is going to be the case right now. Obviously, we have an election coming up, but right now that is scheduled to sunset in 2025 and then revert back to the previous levels. Here's another big change that the Tax Cuts and Jobs Act went about, is they cut the corporate tax rate almost 40%. It went from 35% to 21%, which is a massive, massive tax reduction. And those changes are not scheduled to sunset. So those changes are permanent unless new legislation is passed. But here's the problem, and we've talked about this, and we'll even provide a link to a blog we wrote about the budget deficit and the debt and our thoughts. And it went to exactly this point here, which is that I'd be surprised if many people realize this, but the budget deficit has doubled in just the past 3 years. Our federal debt is now almost 80% of our gross domestic product. It's projected to grow to 144% by 2049, which would be higher than any time in US history, including at post-World War II, which is at 106%. And if the tax cuts that are in place now are extended in 2025, we go to a whopping 219% debt to GDP ratio. Just unfathomable, really. And by the way, that was before the $2 trillion coronavirus aid package. And of course, that was a necessary thing that we needed to do. So I'm not lamenting it, but the point is that that added to the budget deficit and the debt. So what does all this mean, right? Why are we here? What does this mean? What it means is that the government needs money. And retirees are sitting on $29 trillion. So for the first time in 46 years, it's possible, very possible, that your taxes in retirement could be higher, could go up. And that's why we're here. We're here to understand and learn as much as possible to mitigate that inevitable fact. And it may not be just a direct tax increase. It could be increased fees, as we'll talk about, on Medicare and Medicaid, higher taxes on Social Security, lower thresholds for taxation, reduced or extended benefits, changes to inheritance rules. Oh, by the way, changes to inheritance rules, that's already happened. So they're already moving in this direction. We've talked about this in emails we've sent out, blogs. The Secure Act was passed at the end of last year. And what the big thing that did is it used to be that a beneficiary could take the money out from their retirement plans over their entire life, spreading out that tax burden and keeping money in there as long as possible. Now, they've shortened it all the way to 10 years. The money has to be completely out of there in 10 years. So this trend is already happening. So we want to plan ahead, and that's why we're here today, and we want to help you as much as possible. So let's start off with a little tax brain teaser. Bill is retired and has taxable income of $42,475. That includes $38,000 in IRA income, $25,000 also in Social Security benefits. And Bill retired and he loves music, so he's a big concert goer. So based on this income, right, his taxable income of $42,000 and change, it puts him in the 22% bracket. He really wants to go to this concert. He wants to take money out to do it, so he taps his IRA for an additional $1,000. And the question is, how much is he going to owe in taxes on that extra $1,000? So give it some thought. He's in the 22% bracket, right? Takes out $1,000. You would think he's going to pay 22 cents in federal income taxes for every dollar. Therefore, if he takes out $1,000, he should owe $220 to federal taxes, right? Wrong. He owes $407 in tax, which is a 40.7% tax rate on that income. Welcome to tax planning and retirement through the 4 stages of retirement. So here we go. The first thing to note is, obviously, 4J, we're pretty knowledgeable about tax planning, but we are not CPAs. So when it goes to actually getting, tax advice, you should consult with your CPA, but certainly you can do planning with us, and we can refer you to someone if you don't have someone already. So what are the 4 stages of retirement? The pre-retirement stage is 50 to 60, which we'll call the work and save years. Early retirement, 60 to 70, the go-go years, lots of travel. Mid-retirement, 70 to 80, that's the go slower years. And then late retirement, 80 plus, the go slower years. So what are some retirement surprises? And this is something we've experienced in talking about this with clients for many, many years, is that the nature of withdrawing money out of your accounts in retirement is just so different than the accumulation phase when you're working. And some of the biggest surprises in retirement that you're going to see will be inflation, because if you're on a fixed income, inflation plays a much bigger role. Longevity, we talked about that in the last webinar, but you have to plan. There's a 25% chance Either you or your spouse will live to age 95. Expenses, right? Your expenses might not go down as much as you think, and some expenses will be significantly higher, and healthcare costs. Okay, so what's the first thing I need to understand about retirement and taxes? So the first thing you have to understand is you have to know what your after-tax retirement savings picture looks like before retiring, okay? Before retiring. So what does that mean? Well, most people look at their accounts and they say, okay, I have $500,000 in my 401k or IRA. I have $500,000, but the reality is that $500,000 is not all yours, because when you actually go to withdraw that money out to spend it on things, you're not going to get all that money. Some of it's going to be taxed. And if you're in the highest tax rate, let's call it 37%, what you should really look at is the actual after-tax retirement savings that I have in that account is $315,000, right? Or if you're in the 35%, $325,000. And in addition, you need to be aware that you will be required to withdraw a required minimum distribution each year after you turn 72. And any money you pull out of these retirement accounts will be taxable. So what kind of effect will that have based on your various tax rate? This assumes a 6% hypothetical return. For illustrative purposes, we start at age 70 and go all the way through age 95. And this is the cumulative after-tax distributions over the course of retirement. So let's just look at assuming you're in the 33% tax rate, and you're starting with the same principal amount of money, you would have been able to take out cumulatively after tax just over $600,000, okay? Whereas if you're in the 12% tax rate, you would have been able to take out over $800,000. So a substantial increase in what you're able to take out relative to what your after-tax rate is. Okay, but at least I'll have my Social Security to supplement my income, and Medicare is going to cover my health care costs, right? So Social Security and Medicare, not many people know this, they have their own sort of tax traps. They're not necessarily called taxes the way you think of your marginal rate, but they are tax traps, and you need to be aware of them so you can plan for them. So regarding Social Security and taxes, let's go back to Bill, right? Bill, the concert goer. So the only thing that changed in Bill's situation was, rather than take out, right, the $38,000, he said, I'm just going to take out $1,000 more out of my IRA. So the only actual increase to his income before he decided to go to the concert and then after the concert trip was $1,000 increase in his income amount from his IRA. But what actually happened was that his adjusted gross income and his taxable income increased by $1,850. Now, wait a minute. How is that possible? He pulled out $1,000 more. How could his AGI and taxable income increase by $1,850? The reason is what we call the Social Security tax torpedo, which means that depending on how much income you have, a greater portion of Social Security is actually subject to tax. So he tipped over that threshold, which actually resulted in, for every dollar of income that Bill received, an additional $1.85 was added to his adjusted gross income and his taxable income. Pretty crazy. So what does that mean? That means that the income tax that he owes went from $5,134 to $5,541, or an additional tax increase of $407, or 40.7% effective marginal tax rate on that $1,000 that was taken out. That's pretty astonishing, because that's higher than the highest possible rate that someone can be taxed. And it's a result of how Social Security income is taxed. Okay, so more good news here. So how about Medicare and taxes? So the thing you need to be aware of with Medicare is something called IRMA, okay? Income Related Monthly Adjusted Amount. It's the IRMA cliff. So let's take a couple, George and Martha. They have Medicare Parts B and D, okay? So they're in retirement, have Medicare Parts B and D. They have a modified adjusted gross income in 2018 of $271,500. and they decide that they're going to sell stock and realize $1,000 capital gain. Based on their tax rate, they would pay $188 in tax on that $1,000 capital gain. $150 is the 15% long-term capital gains rate, and the $38 hits them because they're over $250,000. They're subjected to something called the net investment income tax, which is a 3.8% surtax on net investment income. So they pay 18.8% is what one would think. But here's what's happened in terms of its interaction with Medicare, the Medicare Part B premium. And I'm going to point you to it right here. They're modified adjusted gross income, married, filing jointly. They were at just below $272,000. After they sold the stock, their income broke through that $272,000 and pushed them into the next bracket, which meant that their premium went up from $289.20 a month, okay, to $376 per month, okay? So, and that continues for that entire year, okay? In addition, that's Part B. Part D, there's another surcharge. So it bumped them up through Part D, 272, right, below 272 to over 272, and that bumped them another $19 per month each. So this may seem, well, 19 here, 86 there, what's the big deal? Well, look at what this adds up to. For George, his extra Part B, $86.80 per month, plus Part D, $19.20 per month, over 12 months, right? That's an additional $1,000.41. And then for Martha, another $1,000.41.60 for a combined total cost as a result of the Medicare surcharge premiums of over $2,500. As a result of what? As a result of selling that stock. So you have to be aware of where you fall on that, on the marginal tax bracket, on that spectrum. So $1,000 capital gain, you would think they'd have to pay $188. But because of the IRMA cliff surcharges, they're actually going to pay $188 plus $2,544, resulting in a $2,732 effective tax bill. Now, that's pretty incredible, right? $1,000 of extra income from the capital gain resulted in $2,730 of taxes, or a 273% real tax rate. Can't make this stuff up. I mean, this is how important this is. I mean, this is a big, big deal. That's a lot of money that, you know, you could potentially prevent by either spacing out the sale or doing other things from a planning perspective. Okay, let's look at another example with Medicare. Here we have a couple, Jim and Ann, they're 68. Jim retired at 65 and Ann 1 year later at 66. And they get coverage through Ann's employer, who offers retiree health insurance. And so the question is, when should they enroll in Medicare Part B? Okay, they should enroll in Medicare Part B as soon as they retire. But the other thing you need to check is if she's still working, right, because she was working at 65, she needs to check with her employer to see whether, because she's now 65, will her health insurance be the primary through work, or will it be the secondary now that she's eligible for Medicare? But if they waited and didn't sign up, you have to remember that Medicare only has open enrollment between October 15th and December 6th. So they would potentially be subjected to a 10% penalty of the first year premium. And the way this penalty works is it's 10% of the first year of the monthly premium, which the lowest monthly premium is $144.60 per month. So that's $14.46 times 12, $173 for two people. So it's $347 for the couple. The problem with Medicare, the Medicare penalty, if you don't enroll at the right time, is that penalty goes on for as long as they live, and the premiums increase every year, so the penalties increase as well. So that one little tiny mistake could translate into a lifetime mistake of thousands of dollars. So you have to watch out for those coverage gaps. Okay, so are there any other tax traps we're going to face in retirement, Josh? So the key number 3 is you must plan how and when you will use your taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. So remember, and I'm just going to do a little bit of you know, retirement planning 101 here. Taxable assets are anything that are not in retirement accounts. So it's your checking account, savings, CDs, your house or homes. It also could be an investment account, right, where you've bought stocks and mutual funds over time outside retirement accounts. So that's all your taxable money. Then you have your tax deferred money. That's your 401ks, your IRAs, your 403bs. And then lastly, your tax-free assets. And that's your Roth IRA assets, right? So that money grows tax-free and can be distributed tax-free in retirement. We want to try to manage between those three buckets to draw from them in such a way that we keep our tax burden as low as possible. And one really, really good way to do this, and something we've worked with a lot of you on where it makes sense, is to consider Roth IRA conversions. And this is particularly valuable between the time period you retire and when you start Social Security, and or before required minimum distributions set in. So what is a Roth IRA conversion? It's when money from your IRA is moved to the Roth IRA. The taxable amount converted is added to your income. So for example, let's say Jill moves $100,000 from her IRA to a Roth IRA. That's called a $100,000 conversion. She's going to have $100,000 added to her income in that year. And the conversion income is going to be taxed at whatever Jill's rate is for that year. So here's a way to think about this conceptually to take full advantage of what we call micro Roth conversions. It's called a strategy called filling up the bracket. So before the conversion, let's say Jill, she had enough income to fill up the 10%, 12%, and part of the way through her 22% bracket. Now she says, well, you know what? I'm looking, I went to these seminars and I've done my homework, and not only am I going to be in a higher tax bracket when I start taking my required minimum distributions in retirement, but I also think that there's a chance that these tax brackets, which are what they are now, could actually be higher. So 22 might be 25, 24 might be 30, 32 might be 36, etc. So what she does says, okay, I'm going to convert everything to fill up my 22% bucket all the way, but not to spill over into the 24. So in her case, she can convert up to $100,000 and stay in that 22% bracket. So she pays 22 cents on the dollar, with the idea that if she hadn't done that and did nothing, then when she eventually took that money out, it could be taxed at 25, 30, or 35%. So she's essentially getting it out at a 22% rate now so that it can grow tax-free for the rest of her life and her heir's life. What are other possible approaches to managing tax brackets? So these are just some other things to think about. Many people have permanent or whole life insurance policies that they started when they were much younger. And one thing you can do is you can withdraw money from those policies in a tax-free manner, and that can allow you to keep your income low during retirement years. Again, this is kind of a unique circumstance that's not going to apply to everyone. Number two is you could sell highly appreciated stock for low or no capital gains. Let's say I retire at 66 and I'm going to wait until age 70 to start Social Security. So the only income I have is anything I sell in that year for spending purposes. Well, maybe I have a really highly appreciated stock, right, that I want to sell. I could sell $60,000, $70,000 worth of gains and potentially pay no capital gains taxes on that highly appreciated stock, or at least very low, like 15%. And then another option is you could take distributions from your IRA or 401k when you otherwise have very low income to take advantage of a lower tax rate. Okay. This, I think, is a really, really important one. So example number 6, you can put an asterisk next to it. It's really, it's charitable giving, tax planning, and retirement. A lot of our clients are charitably inclined, and so they give money to charity, not because of the tax benefit, but because they want to help out their religious organization, their church, or their synagogue, or some other not charity they care about. So let's look at an example to better understand this. Let's take Albert and Shirley. Albert and Shirley are in the 24% tax bracket, and every year they give $5,000 to charity. They have itemized deductions of $15,000, and the standard deduction for 2020 is about $27,000. So because the standard deduction is higher than their itemized deductions, they won't get an additional tax deduction for the $5,000 donation to charity, because they're going to take the standard deduction because it's higher. So there is something called qualified charitable distributions, or QCD for short. And it's available to you once you reach age 70 and a half. And what it allows you to do is to contribute to a charity of up to $100,000 from an IRA per person per year. It must go directly from the IRA to the charity, and it counts as a portion of your requirement of distribution, and it's not reported as income. So you don't get a deduction on the income tax because it's never reported as income in the first place. Now let's look at two different options of how to give this $5,000 to charity. Let's take the approach of, they're not aware of the QCD and they want to give to charity. So they have their IRA, they take out the $5,000 and it satisfies their requirement of distribution. It's reported as taxable income. It goes into their checking account. Then from their checking account, they write a check to the charity for $5,000. Well, the effective cost of that charitable contribution is not just $5,000, it's $5,000 plus the 24 cents they had to pay on that, the 24% they had to pay on that $5,000, or $1,200. So the total cost, if you factor in taxes to that charitable contribution, is $6,200. Now let's look at them doing the QCD. For the QCD contribution, the charity gets $5,000 directly. It's sent directly from the IRA to the charity. The $5,000 satisfies the RMD, and the $5,000 is excluded from taxable income. So there's no tax bill on the distribution. The total cost of that charitable contribution is $5,000, saving them the $1,200 in taxes that would have incurred doing it the other way. That's a very, very big deal. Obviously, we're looking at it with fairly, small numbers, but they can be much more significant. The other thing I want to add before we move on here is, even if you itemized, it still makes more sense to do a qualified charitable contribution, because remember Medicare IRMA, right? The IRMA cliff kicks in as a result of your modified adjusted gross income being a certain level. If you take that money as an RMD directly to yourself and then contribute to charity, yes, you could deduct it as an itemized deduction if your itemized deductions exceed the standard deduction, but your modified adjusted gross income is going to be higher than if you gave that money directly from your IRA in the form of a QCD to charity. If you missed that part, or I lost you there, it's okay. That's a little bit technical, but it's how all this stuff fits together and ties together. Okay, another consideration you may be thinking is, I really hope to pass some assets on to my family. How does retirement tax planning figure into this? And this is a little bit different than estate planning, but it's married to it. So the key number 4 is you want to organize your assets for your family's benefit, and estate planning, of course, still matters. And the big concept, we're going to talk about here, and then we're going to move on to something related to long-term care, is something fairly straightforward that you need to remember, which is the step-up and basis strategy. And let's first define what the step-up and basis strategy is. This is a rule that treats a beneficiary, when they inherit money, as if they purchased the inherited asset on the day it was left to them. So any future gain or loss is based on the asset price on that day. So if your parent bought the stock, or you bought a stock for $10,000 and now it's worth $100, if you pass away and that stock gets passed to your children, their basis is going to step up to $100,000, right? So that's a much better deal. And the reason we bring this up is, a lot of people think at the end of their life, let me get this money out of my estate, let me add my kid to my account so that they can inherit it directly. You have to be very, very careful with all those types of things, because if you gift this asset to your children, guess what? They inherit your cost basis. Now when they go to sell that exact same security, they would have to pay the $90,000 capital gain. Whereas if you just waited and it passed to them at your passing, they would inherit the step, they would get the step up in basis. Now, like anything with this stuff, you can't just look at this in a vacuum, in a silo. Sometimes gifting can make sense depending on what the estate tax exemption is and what your overall estate planning goals are. But just keep this in mind. The step up in basis is applicable to anything that's not in a retirement account and not an annuity. So your home, taxable investments, things of that nature. Taxes and long-term care overview. Okay, so what you need to understand about long-term care insurance that is the premiums you pay may be deductible, depends on income levels, at a federal and state level. If you qualify for long-term care, the payments from the policies for reimbursement of long-term care expenses are tax-free. And you need to be smart about how you pay for those long-term care costs because it can have a big impact on your heirs. So let's look at this an example with Florence. Florence is a widow. She is currently receiving long-term care benefits. They're in-home care, so she's getting the care at home, and it equates to $5,000 a month or $60,000 a year. She has Social Security income of $20,000 a year, and she has a $400,000 IRA. So as you can see, she needs to come up with $40,000 a year to pay for her long-term care benefits. And there's one other thing that Florence did when she was younger is she purchased a long-term care policy with a a life insurance policy with a long-term care rider. And what that means is that if Florence never needs long-term care and she passes away, $500,000 is going to go to her children, income tax-free. Remember, life insurance is totally income tax-free. Okay, it's a huge, huge benefit. But she added a long-term care rider to that policy. And what that means is she can actually access that death benefit before she dies for long-term care costs up to $10,000 per month. Okay, so now the question is, how does she pay this difference? Does she draw it out of the IRA and pay tax, a small amount of taxes on that money that gets drawn out of the IRA each year and leave the life insurance and say, no, I don't want to pay any taxes. I want to use this money because it's completely tax-free. So let's look at both of these scenarios. Scenario one is Florence uses her long-term care policy to pay for 5 years of care. So if she uses her long-term care policy, she's going to pay little to no income tax during the last 5 years, right? High deductibles for unreimbursed medical expenses. And remember, the long-term care insurance pays $300,000 for in-home care, and it's happening tax-free to her. So at the end, she won't have needed to tap her IRA. So $400,000 approximately gets left in IRA funds to her kids, which would be taxable when they take it out. And remember, because of the Secure Act, they'd have to take it out at the most within a 10-year period. And they would get $200,000 in life insurance, so tax-free money in life insurance. So a total of $600,000 would pass to the heirs. That's using the long-term care policy. The other scenario is Florence uses her IRA to pay for the care. Now remember, because of those very large long-term care expenses, Florence is likely to pay very little to no income tax during those last 5 years. So she's going to use about $300,000 out of her IRA to pay for in-home care. She's going to have then $100,000 left in the IRA, which would be taxable money to the kids. But here's the kicker. That $500,000 life insurance policy is totally tax-free. So now you have a situation where the kids get $600,000, but in this case, they're getting 83% of it completely tax-free. Whereas in the other scenario, they're getting basically half of it tax-free. So in this scenario, in this example, her paying actually from her IRA because of the life insurance policy, it's actually a better deal. And so that's just an example of how, when you come to kind of end-of-life decisions around long-term care, being smart about how you would draw this money from your various accounts can make a huge difference, not to you necessarily, but to your loved ones. So how in the world are we going to ever manage this? Well, of course, 4J Wealth is always here to help. But just as a quick overview, taxes and retirement, the pre-retirement side is we need to figure out what your after-tax savings are before you actually retire. And as much as possible, to the extent it makes sense, getting money into Roth accounts is very beneficial. In early retirement, we want to look for understanding Social Security and Medicare taxation, right? Making sure you're aware of those thresholds to try to minimize the IRMAA tax cliff and things of that nature. And also looking for opportunities to do Roth conversions between the time period you retire and before you start taking those requirement of distributions and or before you start taking Social Security. We've done a number of these for clients where we do micro conversions over a period of years to pay very little on the taxes each year and build up a substantial balance in the Roth IRA, which not only is really helpful for the retiree, but it's particularly advantageous to the beneficiary who gets to inherit the money. Mid-retirement, we want to try as much as possible to manage the plan RMDs. Big thing there is qualified charitable distributions, right? That is to the extent you give money to charity, that's a very, very good way to do it. And then later in retirement, organize your assets for tax efficiency and estate planning. And one thing I'd like to mention here is this late retirement, it does not mean that's when you should do your estate planning. Your estate planning should be done now. I mean, I've done my estate planning. I'm very far from retirement. Everyone on our team has done their estate planning because you don't know when something's going to happen. And I think that's a really good topic for another webinar is estate planning. And we will do that as a standalone webinar. But I just want to make that point. This is not saying wait until late retirement to do estate planning. So because your tax exposure is going to change throughout retirement, you want to have a strategy that anticipates how and when you're going to tap assets to cover your expenses, understand the range of taxes and tax triggers that you're going to face at various stages of retirement, and manage and plan those actions so that you pay as low a tax rate as possible. And in terms of it's very, very difficult for someone who's still in the accumulation phase to appreciate, and hopefully this webinar has got them thinking in the right direction, how different the distribution and spending phase of retirement is. It's much more complicated. You're not dealing with Social Security, you're not dealing with Medicare when you're still working. So managing through all those things and the RMDs and the taxes, mistakes can be costly. So we want you to be educated. That's why we're doing these things. Planning, as you know, every client that we work with goes through a comprehensive financial plan. If you're listening to this webinar and you're a client, you've gone through a plan. We continuously update that plan. This is specifically around retirement and taxes, but it fits into your overall financial plan. Like everything we do, this is a part of your overall comprehensive plan. So if you'd like to talk about this in more detail, we will do a strategy session with you. And in fact, if you look at in the chat box in the bottom right, okay, you will see Jamie has put a link to our calendar. All you have to do is click on that link. It's calendly.com/Josh4jwealth, but it's for all of us. And we will sit down with you via Zoom at this point and discuss any questions you have on this. Obviously, for those who are existing clients, we do this on an ongoing basis, but if there's something that has piqued your interest that you want to discuss in more detail, absolutely go ahead and schedule that, or you can email us as well. But the point of that strategy session is to look at taxes and retirement planning in the context of your overall plan. Our job is to be good listeners and to really understand what your goals are from a retirement standpoint and from an estate planning standpoint, and then to work with you. And if you're not working with us currently, that's fine. If you do the strategy session, nothing comes out of it, and you just go about your way, that's fine. And in the best case scenario, we could start working together and helping you. The point is you're not in this alone. It is complicated, and you want to make sure you make the right decisions. Um, so we're going to open it up to questions now, and I hope if you that you can ask questions. You can type them into the Q&A box. The other thing I want to mention, because we do have about 15-20 minutes for questions, is we've come up with these webinars with some feedback, but we want to get a lot more feedback from you in terms of what do you want to hear about specifically. And because of how successful the webinars have been, and people are inviting their family members and friends and people who think this could be of value, we want it, whatever you want to hear about, that's what we want to talk about and educate you on. So please give us that feedback. We strongly encourage it. Okay, so Jamie and Jeff have been handling some questions. So one question is a very good question that we got here is, can you do a QCD in the year you turn 70 and a half, or do you actually have to wait until you turn 70 and a half to do the qualified charitable distribution? Great question. So I can take this one. You actually have to wait until you turn 70 and a half to do the QCD. So this is where the stuff gets really nuanced. You can't, even if you were to turn 70 and a half in November, right, you could take the QCD, but if you did it in March, it's not going to qualify as a QCD. You have to wait until that time period you actually turn 70 and a half, which in that example would be after November. Let's see, another question, and Jamie or Jeff can take this one. Do I have to convert my entire IRA to a Roth, or can I do partial conversions over the years? That's another great question. Jamie, do you want to address that?
Yeah, sure. I'll go ahead and take that. And Josh did talk about this during the presentation, and he referred to it as micro conversions. And it's a great question because if someone retires, let's say at age 60, and they're not required to take required minimum distributions until age 72, and maybe they're delaying Social Security, there's a period of years there that we call the gap years, where income can often be lower during that time than what it may be past age, let's say 70 or 72. So to give an example, I'm working with a client right now that's that's in that period of the gap years. And we're talking about doing conversions, maybe only in the $10,000 to $12,000 range. But if we can do that for the next 6 or 7 years, that's 60 to 70,000 that they'll be able to, it will be added as ordinary income, but we're trying to keep them in the 12% tax bracket. And if they can do that, that gets 60, 70, 80,000, not even talking about the growth on that money, out of their IRA account, where they would be forced to take required minimum distributions at some point in the future. So it's just an effective use of an important tax strategy. Again, we're not always talking about saving thousands and thousands of dollars, but if it's $1,000 here, $1,500 there, that really can add up over time.
That's great. Okay, this is a really good question we had come in. Can I convert my required minimum distribution into a Roth? Right, so I'm taking these required minimum distributions. I have to take them anyway. Why don't I just put it into the Roth? Well, of course, the government saw through that loophole, and they do not allow you to do a Roth conversion on your required minimum distribution, which is why it's so important to try to do the Roth IRA conversions before you reach that required minimum beginning age, which as of now is 72. Jamie, you can take this next one. Would it ever make sense to take IRA distributions before my RMD age versus from a taxable investment account?
Sure. So actually the case that I just talked about is a great example of that. It's taking it in years when your income is lower than what it'll be in the future. For many, they might have pensions, could be a small pension, could be no pension. And again, during those gap years, before the client starts to take Social Security or before they start to take their required minimum distribution, we've got a great opportunity during those years to either take distributions to reduce the total value of their IRA accounts and supplement income, or again, do the Roth conversion and potentially stay in that 12 or 22% tax bracket.
Awesome. Couple people have asked, is it possible to get a copy of the PowerPoint presentation? Yes, we can certainly make the PowerPoint presentation available. And as usual, we're going to upload this because we're recording it to our YouTube channel. So, you know, you'll be able to watch this live or share it live as well. So not only we have the slides, but you'll have the talking points and our comments as well. Couple other questions have come in. So somebody asked, why didn't she have to take the RMD from her IRA? I think the question is related to the woman who was the widow. And the answer is she did have to take an RMD from her IRA. She did have to take the RMD from her IRA. The idea there is the reason it stayed at 400,000. It's an illustrative example, but if she had to take out 4 or 5%, the account grew at 4 or 5%. It stayed at that level. But the reason the taxes were low is, one, her income was low, but also she had substantial deductions because of the long-term care expenses. Another question here: is there a point where it does not? Is there a point where it does not make sense to do a Roth conversion? Interesting question. Jamie, you want to? We can both answer, but you want to start?
Sure. Yeah. I mean, the general factor that we would look at is what tax bracket you would be pushed into by taking that additional dollar of income. That would be your marginal bracket. So obviously, if you're in one of the higher tax brackets, and you know, you're 60, 70, or potentially older, a Roth conversion may not make sense because you'll be paying ordinary income taxes at the marginal rate, which again is, remember, everybody has an effective tax rate that they pay taxes on, and then their marginal rate. And the marginal rate is each additional dollar of income will be taxed at that level. If that's, you know, generally 24% or higher, then we would have to look at your individual situation to see if it makes sense, because we don't want to get caught in one of those traps that Josh went over, the examples in the very beginning of the presentation, where it affected how much they were going to then have to pay for Medicare, as an example.
Yeah.
Cases like that, we may come back and say it doesn't make sense, but that's where we really have to look at the individual situation. Generally, if you're in the 22% bracket or lower, especially if you're in the 12% bracket, then you're not going to run the risk of getting caught in that Medicare trap where your premiums would go higher in future years. So generally, that's where it makes a lot of sense.
Yeah, and of course, it does always depend on your goals. I mean, if your primary goal at a certain stage of your life is to maximize the wealth to the next generation, even at, you know, a higher tax rate, the conversion could make sense. And this actually goes to the answer to the second question, another question that just came in, which is, does a Roth IRA have a requirement of distribution? Awesome question. The answer is no. So meaning that money that goes into the Roth, not only does it not tax, but you don't have to take anything out of it while you're alive. When your heirs inherit that, the money they take out will still be tax-free, but they will have a requirement of distribution. And it used to be they could stretch it out over their whole life. Unfortunately, now they'd have to take that out over 10 years because of the Secure Act. But there is no requirement of distribution on a Roth IRA over your life. The beneficiary, yes. Link to the YouTube channel. We can when we send out the follow-up email, the link, we have to upload it there, and then when you click on it, you'll see. But if you just go into YouTube and type in 4J Wealth, you'll see all the previous videos we've uploaded there. All right, we had a lot of questions. We talked about, yes, you can get a copy of it. So again, if if you want to now, or you want to think about it, but let us know future topics that you want to hear about, and we're more than happy to take that feedback. We want that feedback because we want it to be as interesting as possible to you. And don't forget that in the chat box in the bottom right, some people are having trouble. You just click on the chat box, and you should see the link to the calendar. You just click on that calendar link. You can schedule a time to speak with us about any of this in more detail. And if you want the name of a CPA that we work with, who we really like, we have several, we're happy to provide that as well. So again, we are available to you. You're not in this alone, and you really should give yourself, a pat on the back for sitting through this. Hopefully it wasn't too torturous, but this stuff is so important, and we are at a precipice where things are going to change. We think a lot. Taxes are very likely to go higher, and that's this type of planning becomes so much more important. And again, it is a part of what we do, but we always look at the big picture. So comprehensive financial planning is the key.
That's a suggestion.
Okay, someone had a suggestion. Future, how should investments change with age? So that's something we can cover in a future webinar. Thank you for that suggestion. How should your investment mix change with age? Looks like there's another one that popped up, Jamie.
That's the YouTube link that Jeff.
Okay, Jeff just put
in the chat
link. That looks like he just shared it with us though, so we want to include that. If you could do that in the chat box, Jeff, there we go. He just did. So go to the chat box, you click on that. That's our YouTube channel. Thank you so much, everybody. We love doing it. We're going to keep doing this, and we'd love to talk to you about this if you want to. For those of you who have not ever spoken with us, or this is your first introduction, welcome. We hope to speak with you individually, and see you at our next webinar in October. Bye-bye.
Thanks, everyone.